Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment. Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. You know, in this episode, this session, I want to get into the idea that, things have really surprised to the upside, and yet there are risks that are building. And it's kind of a theme, right? And so let's jump into it. We know that there's been optimism around artificial intelligence. We've talked a lot about that in our work on long-term investment themes. We encourage people to go to stifelinsights.com and check out that report. But we talk about things like the fourth industrial revolution, where technologies and innovation is breaking down boundaries between the physical, digital, biological worlds. Our worlds are changing, right? And so really across all our themes, artificial intelligence is in the thick of it. And we know that that there's investment opportunity. We've talked about enablers and innovators and disruptors. But overall, there has been through the year and some last year's optimism, right, about different applications. And we've sort of built out a view across different industries. So think in terms of media and entertainment, the idea of automated content creation, or think about healthcare and the idea of accelerated and improved drug development, or think in terms of the consumer experience and smart shopping, which we've talked about before, or even something sort of mundane. So in the industrial sector, think of, being able to predict when maintenance needs to be done on equipment or planes or something like that. So there's just, a lot of uses, a lot of spending, a lot of electricity needed. And yet when we look across firms by industry, most industries have think of it as mid-ish single-digit adoption in terms of companies actually using AI to do what they do. So anyway, that's been optimism, and the economy has surprised to the upside. We're anticipating, we're relatively soon getting the next update on GDP, the first estimate for third quarter. But anyway, GDP has performed above expectations. And yet when we look at data like the manufacturing sector, we're seeing signals of a potential contraction. I will say this, we've been parsing and watching the earnings reports and related meetings with CEOs as it relates to the consumer. And for a while, we were seeing a lot of negative commentary, but candidly, in the most recent reports we checked out from companies like Uber, Wells Fargo, JP Morgan, Bank of America, the comments on the consumer have sort of gotten better, meaning there's signals that things aren't quite as bad and that people are hanging in there okay. Now, there's still a number of negative comments for sure, but we're pretty focused on the consumer. Retail sales surprised to the upside in its most recent reports. Sentiment and confidence has gotten just a little bit better, and yet we're seeing the interest on debt going up, and we're seeing delinquencies go up. So, some positive senses about the consumer, but some points of stress. In any event, another newsworthy event was we had inflation reports, and most notably consumer price index surprised a little bit to the upside. So think of it as not an alarming number, but a firm number for sure, and a little higher than expectations. And so, people are very aware that inflation needs to stay down near the Fed's 2% target for the Fed to keep cutting rates. And in fact, when we look at Fed funds futures, there was a lot of optimism that the Fed was going to do a lot more this year and next year in the wake of their September half-point cut. Since things like the inflation report I just mentioned and even some firmer labor market reports, basically those forecasts for cuts have softened a little bit. And for example, right now, I think it's 2 more quarter-point cuts this year, one at each of the next meeting with the Fed for the balance of the year. That's what the Fed futures are signaling, right? And so anyway, just think of it as a focus when one issue is focus on Fed policy and the potential for policy error. That's something that's in focus. Now, next up is really our fiscal trajectory. So we've been borrowing a lot of money as a government and spending it, and that's probably helping keep the economy going in the way that it has. But as we've talked about before, we need to go through a fiscal transition. We need to see the segments of our economy, consumers, businesses, the government, basically retool for the fact that we have higher interest rates. And in fact, before we had higher interest rates, all three segments of our economy built up debt. Now, I want to focus in on the government. So, the deficit is estimated now for 2024 to be at $1.8 trillion, bringing total debt above $35 trillion. Now, as it relates to the cost of debt, think of it as, 16% of our revenue is how much we're spending on interest payments, and that's over a third of our discretionary spending. Now, more alarmingly, the CBO, so the Congressional Budget Office, is basically forecasting in 2034, so 10 years from now, a deficit of $2.8 trillion and a total debt level of $57 trillion, where that percent of discretionary spending goes up to 43%. So we're very focused on this. And in fact, one of the things we've been monitoring, the politicians really won't talk about it. We'll see what happens after the election. But corporate leaders are starting to talk about it. And we sort of monitored speeches and quotes and interviews of, for example, CEOs of big financial services firms. So, for example, BlackRock's Larry Fink, CEO of Larry Fink at BlackRock, his quote is, quote, "We have rising deficits. No one is spending enough time talking about deficits. We need to be finding ways to minimize the role of the deficit on the economy, on interest rates, and on inflation." And then another quote from Jamie Dimon, quote, "Any country can borrow money and drive growth, but it may not always lead to good growth. So I think America should be quite aware that we've got to focus on it more," end quote. So, there's just, well-known leaders in the corporate space, in this case, financial services, that are sort of starting to beat the drum. Hey, we've got to focus on this. And we remain optimistic that we will do that, but we've got to get politicians to focus on that. Anyway, so that's an issue that we're very much aware of, mindful of. But to come back to my main point about the economy, we've seen it perform above expectations. And the consensus forecast for the balance of the year leads us to a print, if you will, of GDP for 2024. The estimate is at 2.6%. Long-term trend is 2.1, looking back. And in 2025 is looking to be below that long-term trend. The consensus rate is 1.8%. Now, we have elections in a few weeks. Punchline is, things seem up for grabs across all three segments: the White House, the House of Representatives, and the Senate. As it relates to monitoring what's important to voters, the categories that remain at the top of the list, capturing in round numbers around 50% of the people listing them as their top, maybe just a little less than that. But inflation and prices, jobs and the economy, and immigration. Those are the top three categories. And obviously a lot being said by candidates around that. Now, you can't, I really believe that all three races, if you will, are up for grabs, but we've seen in the predictive models sort of a shift where Trump has come back into favor based on those predictive models. And in fact, the Republican sweep probability based on those models is up a little bit. It's up just above 40%, which again is the biggest number I've seen in a while. So anyway, as it relates to what we think in terms of the implications of the election, we know, and we're just thinking in terms of sectors and areas that we have to focus on depending on who wins. So we know for sure the financial sector is something that'll come into focus in terms of the levels of regulation. We know energy as it relates to energy policy. We know technology, both on a top-down basis, like how supportive will the government be to mergers, for example. And then on a bottom-up basis, think things like semiconductors, trade policy, trade negotiation is going to be key to how technology, for example, flows around the world. So again, a lot of different considerations, but our process this year for sure is to kind of wait and see how things land, and then we'll go from there. In any event, turning to the markets, what we've seen, as we discussed last time, I'm sure, is the yield curve, so the yield across maturities for treasuries, is starting to normalize, meaning generally a positive slope. And if you look at basically the from about the 3-year rate on out, it's positively sloped, but the short end is still higher, and that's almost like the market's just waiting for the Fed to cut rates a little bit more. But all in all, yields remain elevated, which is good for bond investors looking forward. We can put money to work and see decent yields to maturity on portfolios and that kind of thing, which is good. When it comes to the equity market, it's been kind of the same story, right? The market's operating, it keeps going up. It's operating at a premium, 25% premium to the 10-year average based on PE ratio, that meaning the S&P 500. And when we look at equal-weighted results, that had been kind of flat in a valuation sense, but it's actually now sitting at a 5% premium. We continue to see, still the market broadening out. And in fact, when we look at fiscal year 2025, earnings growth forecasts, we see sectors like healthcare, like industrials, and like materials anticipating, in the case of those areas, very round numbers, about 20% earnings growth next year. Now, that's against a backdrop where actually, generally speaking, the view on earnings has declined. And I ran some data just to look at the quarterly. The pattern generally is, not always, but generally is, when you look back a year ago, there's a certain rate. So let's take third quarter 24. The estimated growth rate for third quarter 24 a year ago was 8.9%. 6 months ago, it eroded a little bit. It was 8.5%. Now we're starting third quarter earnings season, so the results are baked, but it's still early. We don't know all the results. The actual results combined with forecasts of those to report down to 2.8%. So this big decline in earnings estimates, earnings revisions. And that, again, is one signal that, things may be calming or cooling a little bit. We have talked a little bit about a rotation that we think started around the second week of July, where the big cap tech-oriented companies like the Magnificent Seven had been dominated. They've rolled over. And so we've seen a little bit of a rotation and a broadening out. So for example, since this is the date we struck, the 10th of July, the equal-weighted S&P 500 has returned 10.4%. This is through October 16th, versus the cap-weighted at 4.1. So again, that dominance kind of shifted around a little bit, and that's a pattern we've seen come and go over time. Now, I mentioned a couple issues like the fiscal trajectory and sort of and what that might mean in terms of the dollar and debt. Like, we have to worry about our fiscal or lack of fiscal discipline having an influence ultimately on the confidence in the U.S. as it relates to debt and the dollar. But there are other issues that we're mindful of. I mentioned Fed policy and Fed policy error risks. We have obviously the Middle East conflict and what's happening there. And then we've got the prolonged Russia-Ukraine war. And then finally, when we look out to the global economy, we see weaker economies in areas like China and Germany. We have to be mindful that, as I mentioned, this downward revision of earnings, like, we have to just watch for a slowing economy that could trigger weaker than expected earnings. These are all headwinds that could sort of influence our economy, our earnings, and our market levels. Now, I did want to spend just a minute and share a couple comments about our asset allocation views. Recall that we do offer guidance on how to allocate, and most of that's strategic, be diversified. Here are some mixes that relate to risk levels, et cetera. But we do also offer dynamic views, and a couple of the leanings that we've maintained in the equity space. One is an overweight to small cap. We think it's a good environment for active small cap. So we're guiding active investors to be overweight to small cap. More broadly, we're outside the U.S., overweight to Japan, and basically just feel good about that market, that economy, and that market. On the bond side, really in consideration, in good part of the stronger than expected environment, we've actually taken off our modest, they were very modest quality leanings. So we were a little bit overweight investment grade versus high yield. We've gone back to neutral. We were a little bit overweight government in investment grade corporates, and we've gone back to neutral when it comes to, for example, government and corporates. And so just a couple of minor tweaks. I'll end anyway, as I always do, with an invitation to check out stifelinsights.com. The body of work that we've just gone through, as well as a bunch of other stuff, is available there. Really appreciate you taking the time. Now, next time we talk, it will be after the election, so we'll have a lot to talk about as it relates to that. Anyway, thanks so much for listening to this episode, and we'll catch you on the next one. Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.